Hello, students. Nice to meet you again. Let's start our next session in the course of alternative investment. And first, let me briefly guide you through the test. So generally, you done this test well. So it's pretty good. This red cells with open question is fine because you have many options to answer the test. So you should put attention to very few numbers of questions. So let us go through. Okay, let's have a step-by-step walkthrough. So if you will have any questions, please raise a hand or type in a chat. I will answer. And while we are working through the answers, we'll wait for the rest of your team. I want as many as it's possible for you to join our session. So let's move on. The first question was about co-investing, and yes, in co-investing, the investor is able to invest both directly in and indirectly in the same asset. That the open question: what is the advantages of direct investing for investor? And you can see that advantage of direct investing is that the investor can avoid paying ongoing management fee, and it also has a great flexibility, but at the same time he should be aware of all the details and be more proficient, and as if in the case of fund investing or co-investing. So in direct investing, investors put capital in their business without the use of intermediaries. So you directly invest. Then an investor with limited investment and due diligence expertise will most likely invest in funds because he has no necessary expertise and cannot perform due diligence on a respectable level. So he or she should choose fund investing. Then from perspective of investor, the most active approach to investing is direct investing. That's the same thing. If you invest direct, that you manage this investment, you should be aware of all the details. You should actively manage it, etc. In comparison to other alternative approach, the co-investing is more likely, subject to adverse selection bias because the fund manager may take and make less attractive investment opportunities available to co-investor while allocating its own capital to more appealing deals. So as far as co-investor is considering to invest not in the fund, then there is no additional incentive for fund manager to put on the table all the best opportunities. And relative to co-investing, direct investing, due diligence is more likely more independent. Yes, you have your own opinion about the investment, and you shouldn't rely on the results of due diligence that were prepared by the fund manager. The investment method that typically requires the greatest amount or most thorough due diligence from an investor is, again, direct investment. It's all your responsibilities. Investment in limited partnerships are less regulated than offerings to the general public. That's true. A performance, or sometimes called incentive or carried interest fee, is typically added to a management fee for a fund. Then the minimum rate of return the general partner must exceed in order to gain an incentive for performance fee is a hurdle rate. And the alternative investment fund's hurdle rate is a minimum rate of return the general partner must exceed in order to earn performance fee. That's about the provision or some other definition. Let's check. An investor in a private equity fund is concerned that the general partner can receive incentive fee in excess of the agreed on incentive fees by making distribution over time based on profits earned rather than making contributions only at the exit. What is the following is most likely to protect the investor from general partner receiving extra fees? Yes, it's a clawback provision. It means you can clawback the money you already give to the fund manager if he or she performed not well. Then until the committed capital is fully drawn down and invested, the management fee for a private equity fund is based on committed capital. So it's again to avoid the misleading incentive for a fund manager to invest as much as it can, but not considering the appropriateness and the performance of each investment. So he or she will receive the same amount on the whole capital committed, but not the really invested or drawn down. And the distribution method by which profit generated by a fund are allocated between LPs and GPs is called a waterfall. And there is others things that's not devoted for the waterfall. It's distribution of profits. A fair distribution is not of business for investing. And fill the blanks with correct words. An American waterfall distributes performance fees on a deal-by-deal basis and is more advantageous for general partner. Of course, he or she receives the money earlier than it can be. So, is there any questions regarding the quiz? Something we need to explain in detail, or it's fine? Okay, so let's move on. And today we will talk about the hedge funds. I will switch to demonstration. So here's hedge funds. And we will discuss and explain investment in hedge funds and discuss and explain its strategies, its subcategories, potential benefits and risks, fee structure, and the process of due diligence, and some specific features of these processes. Then we will describe, calculate, and interpret management and incentive fees on the net of fee returns of to the hedge funds, and describe issues in calculating returns on the hedge funds, and especially the issues in valuing hedge funds, assessing its performance, etc. So let's move on. Hedge funds have a very interesting and diverse history. So starting in 1988, Alfred Winslow Jones, a sociologist investigating fundamental and technical research in order to forecast the stock market for the Fortune magazine, set up an investment fund with himself as a general partner, and the fund followed only three tenets: always maintain short positions, always use leverage, and charge only an incentive fee or performance fee, that is 20% of profits, with no fixed fees. And Jones called this portfolio as a hedged fund. That was eventually shortened to the hedge fund, because his short positions offset his long positions in the stock market. And theoretically, the overall portfolio was hedged against major market moves. Although Jones' original three tenets still have some relevance to today's hedge funds industry, not all of hedge funds restrict themselves to equities. Many trade sovereign and corporate debt, commodities, future contracts, options, and other derivatives. Even real estate investment are found in hedge fund structures. no dual hedge funds maintain short positions or use leverage. Instead, many simply exploit niche areas of expertise in a sophisticated manner. Hedging and leverage may or may not be a part of it. Fee structure has evolved to include management fees in addition to Jones incentive fee. The performance fees we discussed in the previous lectures, and they may vary from the simple 20% and including hurdle rates and other mechanisms. Investors in the modern hedge funds are subject to extended holding periods known as a lockup periods, a subsequent notice periods before an investment redemption is possible. Such mandatory periods combine with a lighter regulatory compliance burden that mutual funds face, for instance, and this allowing hedge funds to have more flexibility. Most hedge funds do not need to guarantee liquidity on one day's redemption notice, as a large majority of mutual funds have to do. Instead, they may avail themselves of less liquid and unnoticed opportunities. The true valuation of these opportunities may at times be opaque. And hedge funds are generally deemed riskier from an oversight, for example, fraud risk, but some hedge funds take less absolute market risk in their portfolio construction than registered products available to retail investors might take. And the distinction between regulatory risk and the illiquidity risk when compared with true market risk is often confused. So, the contemporary hedge fund generally has the following characteristics. It is creatively, actively managed portfolio of investments involved in one or more asset classes that can be equities, credit, fixed income, commodities, futures, foreign exchange, and sometimes even hard assets such as real estate. Sometimes trading in a different geographic regions that is often leveraged, generally takes both long and short position, and quite often use derivatives to express a view or establish a hedge. The goal is to generate high returns, either in absolute sense or in a risk-adjusted basis relative to its portfolio level volatility. It may be hard to gauge a hedge fund's performance relative to a traditional index benchmark, and it generally enjoys light investment restrictions that are detailed in each hedge fund's private placement offering memorandum. A hedge fund is set up as a private investment partnership or a shore fund that, under certain legal restrictions, make the offering open to a limited number of investors willing to be able to make substantive initial investment on mid and long-term horizons. So the lockup periods, the notice periods should always be considered when you're, as an investor, deciding to invest in a hedge fund. And as we noted previously, restrictions on redemptions are typically imposed. Investors may be required to keep their money in the hedge fund for a minimum period, that is, lockup period, before they are allowed to make withdrawals or redeem shares. Investors may be required to give notice of their intent to redeem, and the notice period is typically from 30 to 90 days. To redeem shares, investors may be charged a fee, typically payable to the fund itself, and so it is not a disadvantage for remaining investors of the fund, and particularly in a circumstance where the redemption takes place during the lockup periods, it's very important. This characteristic is called a soft lockup, and it offers a path to redeem early. Again, Such restrictions allow hedge fund managers more flexibility in portfolio construction, giving them leeway to invest in situations in which time may be needed to generate an expected return, and that therefore are not typically suitable for a mutual fund that offers daily liquidity. Then there is another structure called funds of hedge funds. That is, funds that hold a portfolio of hedge funds. They create a diversified portfolio of hedge funds and invite participation from smaller investors or those who do not want to have the resources, time, and expertise to choose among hedge fund managers. Also, the managers of funds of hedge funds, let us later called simply funds of funds, are required to have some expertise in conducting due diligence of hedge funds and may be able to negotiate better redemption or better fee terms that individual investors can. And funds of funds may diversify across fund strategies, investment region, and management styles. But funds of funds may charge an additional 1% management fee and an additional 10% incentive fee, that is also called like 1 and 10, on the top of the fees charged by the underlying hedge funds that held in portfolio funds of funds. At both the hedge fund level and the fund of funds level, the incentive fee is typically calculated on profits net of management fees. Fees structured are important to scrutinize. Fee layering can solely reduce the initial gross return on an investment of the hedge fund, of funds, or funds, or just a hedge fund. And each hedge fund into which the funds invest is structured to receive a management fee plus an incentive fee. The result may be that the investor is paying fees more than once for the management of the same asset. And finally, liquidity can be an additional concern for investors in funds of funds in a time of crisis when fund redemption can hurt performance. That means you can invest in the funds of funds. It provides you more flexibility in choosing the variety of investments, assets, styles, strategies, etc., that allow you to invest with less amount of money, but all comes with the price. You have to pay definitely additional performance fee, and probably the fee structure will lead you to the situation when you pay for the management of the same asset twice. So here is a short slide with all the characteristics of the hedge fund and funds, its pros and cons, bring to the one place. So I highly suggest you to keep the slides, and it will help you when you will prepare for the test, exams, etc. Then let's talk about this amounts of incentive fees and management fees. And you know that few investors were worried about high fees as hedge funds were achieving average net of fee returns of from 10 to 20% in the early 19th and early 21st century. But as returns migrated towards lower levels like 6 to 9%, and the drag on returns from fee structures became much more relevant on a percentage basis. Institutional investors challenged the high fees, and in late 2013, the largest pension fund in the United States, called PERS, announced it would curtail its hedge fund allocation, partly for this reason. So everything comes for the price, and when your returns are shrinking, then a lot of investors begin to consider about this additional management and performance fees. By 2018, the average hedge fund fee level had compressed to 1.3% in management fees and 15.5% in incentive fees, considerably less than the 2 and 20 structure envisions, but still quite high relative to traditional mutual funds. Fund of funds fee levels similarly have compressed. Funds of funds can be found charging, for example, either 1% flat management fee or 50 basis points management fee and only 5% incentive fee. Realization of the value destruction potential of fee layers conspired with increasingly compressed hedge fund returns, leave funds or funds far less popular in 2020 than they were between 2000 and 2005. Still, a fund of fund may offer compensating advantages such as access for small investors, diversified hedge fund portfolios, better redemption terms, and due diligence expertise. The overall popularity of hedge funds is illustrated in this table by assets under management and net asset flows. The research conducted by a organization called Hedge Fund Research Incorporated, or HFR for short, reported that the assets under management grew from approximately 39 billion in 1990 to 491 billion, so more than 10 times in 2000, and to 3.3 trillion, so again nearly 10-time multiple as December of 2019. A clear decade-spanning boom in investment, even in growth, has slowed somewhat in the last 5 years. The table compares returns, risk, and performance measures for the this organization HFR Fund of Fund Composite Index and MSCI Index and the Bloomberg Barclays Global Aggregate Index. So hedge fund indexes suffer from issues related to the self-reporting and survivorship bias. We already touched on this survivorship bias, and this bias relates to the inclusion of only current investment funds in a database, and as such, the returns of funds that are no longer available in a marketplace, for example, they have been liquidated, are excluded from the database. So, however, this HFR Fund of Funds Composite Index reflects the actual performance of portfolios of the hedge fund. So, if you're constructing your index only on the actual indexes, that probably you should be aware about or about the survivorship bias. That means that components of index that not performed well were excluded, so the performance of index is upward biased. The measures shown in this table may reflect a lower reported return because of the added layer of fees, but they likely represent a fairer, more conservative, and more accurate estimate of overall hedge fund performance than the HFR's composite index of individual funds. The returns are likely just mildly biased toward equity long-short funds, since there are always a substantial portion of funds allocation mix. And this table shows that data for over the 25 period between 1990 and 2014, hedge funds enjoyed higher returns than other stocks or bonds, and a standard deviation almost identical to those of bonds. On the basis of Sortino ratio, hedge funds do not appear as attractive as bonds if returns are adjusted to downside deviation, as reflects in the relative Sortino measures that shown again in this table, next table. Sorry, no, this one. The worst drawdown or period of largest cumulative negative returns for hedge funds and global equities began in 2007 and ended in 2009. So you can see the Sharpe ratio is pretty good for funds of funds and global bonds, but the Sortino ratio is less attractive for funds of funds than for global bonds. So we should keep in mind the general approach for measuring the performance of alternative investment, that the measure that works well in the world of traditional investments that have this normal distribution, this very clear tails, symmetry to the mean values. This the distribution of returns for alternative investments is quite different. It's skewed, the kurtosis is high, etc. And we'll discuss it in detail in a session devoted to performance measurement and risk management. So hedge funds are typically classified by strategy, although categorization may vary. Many classifying organizations focused on the most common strategies, but others classify on the basis of a different criteria, such as the underlying assets in which the fund are invested. Classification change over time as new strategies, often based on new products and market opportunities, are introduced. Classifying hedge funds is important so that investor can review aggregate performance data, select strategies with which to build a portfolio of funds, and select or construct appropriate performance benchmark. Again, Hedge Fund Research Incorporated classifies hedge funds under 4 broad categories: event-driven, relative value, micro, and equity hedge. And as of March 2019, hedge fund assets stood at approximately 3.2 trillion. And this table shows the approximate percentage of hedge fund asset under management by strategy. And according to the research organization, Hedge Fund Research, for the periods 1919, 2010, and 2019. And based on these assets under management measure, event-driven and relative value strategies have grown in popularity during the last 30 years, while macro and equity hedge funds have declined. And that's all proof what I said before. So these relative value and event-driven strategies, younger to the macro and equity hedge funds that was the strategies developed long ago. So again, we have new quantitative strategies, the hedge funds that employ and follow so-called black boxes methods when they have the machine and the analytical schema that employs not only some methods that can be analytically derived, but these neural networks that just employ the statistical data rather than any analytical derivation of the relationships. And I think that we can, on one slide, when we'll talk about the top hedge funds, I will give you figures, and we can see that the most increase in the assets under management of these funds, probably by chance, but it falls in hands of the hedge funds that greatly employ these new technologies. So we'll see in next slide. Okay, let's go for the strategy and start with the equity hedge fund strategy. Equity hedge strategies can be thought of as an original hedge fund category. They are focused on public equity markets and take long and short positions in equity and equity derivative securities. Most equity hedge strategies use a bottom-up security-specific approach, so company-level analysis, followed by overall industry analysis, followed by overall market analysis, with relatively balancing long and short exposures. A top-down approach, in contrast, entails global macro analysis, followed by sector and regional analysis, followed by individual company analysis, or any market timing approach. Some strategies use individual equities only, whereas others use index ETF securities for portfolio balancing purposes. The examples of equity hedge strategies may include the following so-called sub-strategies. The market neutral. These strategies use quantitative or technical and fundamental analysis to identify under or overvalued equity securities. The hedge fund takes long position in securities it has identified as undervalued and short positions in securities it has identified as overvalued. The hedge fund tries to maintain a net exposure that is neutral with respect to a market risk and other risk factors like size, industry, momentum, value, etc. And ideally, the portfolio has an overall beta of approximately 0. The intent is to profit from the movements of individual securities while remaining largely indifferent to market risk. To achieve a meaningful return, market-neutral portfolios may require the application of leverage. They are generally stable, low-return portfolios, but are exposed to occasional spurs of volatility, at which point sudden leverage reduction may be required. Then we have fundamental long-short growth. These strategies use fundamental analysis to identify companies expected to exhibit high growth and capital appreciation. The hedge fund takes long position in these companies while shorting companies with business models that are being disintermediate or are under downward pressure, where continued revenue growth is deemed unlikely. So long-short growth measures tend to end up with long biased overall approach. The fundamental value. These strategies use fundamental analysis to identify companies that are deemed undervalued and unloved for any number of corporate performance or sector-driven reasons. But the measures identifies a path to corporate rejuvenation. The hedge fund takes long positions in these companies and sometimes hedges the portfolio by shorting index ETFs or more growth-oriented companies deemed overvalued. Such measures also tend to be long biased and have a positive factor bias to value as well as to small small capitalization factors, since many underappreciated value situations tend to reside in a small capitalization sector. Short biased. These strategies use quantitative and fundamental analysis to focus the bulk of their portfolio on shorting overvalued equity securities. Many of these funds are more forensic in their fundamental analysis, and some turn activists by trying to expose previously unrecognized accounting or business flows, thereby also improving their own portfolio's chance for profit. The degree to which these funds adjust their short exposure over time varies by manager. Such managers tend to be contrarian by nature, and the funds can be useful additions to larger portfolios in terms of weathering periods of market stress. Short biased managers, however, have had a difficult time overall posting meaningful long-term returns during the past 30 years of generally positive market conditions. And we can see again that even considering the last crisis, the broad market is growing. So it's always a problem to maintain short position, profitable short position for long. Then sector-specific strategies. These strategies exploit manager expertise in a particular sector and use quantitative and fundamental analysis to identify opportunities. Technology, bioscience, life science, financial services are common areas of focus for these strategies. Given our era of increased democratization and the dissemination of news, added sector-specific expertise to be a prerequisite for truly differentiated security selection. The more complex a sector, like biotechnology or drug trials that within the biotechnology or something high tech, or the more opaqueness in accounting practices, as with financial and insurance stock, especially this new crypto currency companies, crypto stock exchange, that's very opaque in the accounting practices, and we can see a lot of cases against these companies, lawsuits. The more this happens, the more value sector-specific managers should be available in the management company or during the selection process. So we can have a short break now for 5 minutes, and then we will continue with discussing the strategies for hedge funds. So if you have any questions, we can discuss now. Please raise a hand. We'll talk, but generally, let us have a 5-minute break. So see you in 5 minutes, okay? Okay, let's proceed to the event-driven strategies that seek to profit from defined catalyst events, typically those that involve changes in the corporate structures, such as acquisition or restructuring. This strategy is considered to be underpinned by bottom-up security-specific analysis as opposed to top-down analysis. Investments may include long and short positions in a common and preferred stock, debt securities, and options. We can further subdivide this broad category into the following subcategories, like merger arbitrage. Generally, these strategies of merger arbitrage involve going long, that means buying the stock of the company being acquired at a discount to its announced takeover price, and going short, that means selling the stock of the acquiring company when the merger or acquisition is announced. Then the manager may expect to profit once the initial deal spread narrows to the closing value of the transaction after it's fully consummated. The spread exists because there is always some uncertainty about whether the deal will actually close in the face of legal and regulatory hurdles. And equally, a sudden change in market conditions could damage the perceived attractiveness of the merger to the acquirer, who could step away. And shorting the acquirer is also a way to express the risk that the acquirer has overpaid for the acquisition or will suffer from an increased debt load following the merger. The primary risk in merger arbitrage is that the announced merger or acquisition fails to take place and the deal spread re-widens to pre-merger levels before the hedge fund manager is able to unwind the position. Still, the expected risk and return on a major arbitrage strategy typically starts off being quite modest. Managers regularly use leverage to amplify merger spreads into a financially worthwhile total return targets. And unfortunately, this application of leverage also increases the magnitude of losses spread should the real world circumstance move against the manager's bet. Give me an example for your. For example, let's consider a firm is trading and 20 euros per share, and another firm makes an acquisition bid at 33 euros per share, and upon the announcement of the deal, the share price of target firm immediately jumps to 30 euros. Many shareholders of the target firm may immediately sell their shares after 50% overnight gain from 20 euros to 30 euros. The hedge fund seeks the profit of 10% by buying the target firm at 30 euros and waiting for the merger to consummate at the eventual price of 33 euros. The most sophisticated strategies tend to be used when the bidding firm offers its stock rather than the cash to finance the proposed acquisition. And then the largest risk to traditional merger arbitrage occurs when an announced merger is not completed, which can result when shareholders, managers, or regulators reject the merger. Traditional merger arbitrage may be viewed as being analogous to writing an insurance. The shareholders who sells their shares of the target firm on the day the merger is announced are effectively buying insurance like protection from the merger arbitrage fund against the risk of a failed deal. The hedge fund seeks to profit by 10%, but risks of potential huge decline if a merger fails, because failed merger typically leads to a sharp decline in the price of the stock of the target firm. The performance of a merger arbitrage manager depends on the manager's success in predicting each merger likelihood. Additionally, merger arbitrage funds typically perform well in healthy economies that tend to stimulate high levels of merger activity. So you see, this is the nature of distribution of the returns for the alternative investment. We have a very low probability, but with very high magnitude of your losses. So if you will fail on this merger deal, you'll probably experience a very huge losses because you used leverage. But again, the probability of this event is very low, but who can and how someone can access the probability of this event? This means the very proficient specialist in a field of corporative actions, especially in a merger, should be in your team to assess well the probability of such event. Then we have another. Sorry, I should move to the next slide. Sorry. Oops, here you are. Then we have, so we talk about the merger arbitrage. Then we have distress restructuring. The distress restructuring and these strategies focus on the securities of companies that are either in bankruptcy or perceived to be near bankruptcy. One strategy sees huge hedge funds simply purchasing fixed income securities that are trading at significant discount to par, but are still senior enough to be deemed money good. It means they can be backed by enough corporate assets to be fully repayable at par, or at least at significant premium to the available bond purchase price. That can be in a bankruptcy situation. And alternatively, a hedge fund may purchase so-called fulcrum debt instruments that is expected to convert into new equities in a case of restructuring or bankruptcy. We can have an activist strategy. The term activist is short for activist shareholder. Here, managers secure sufficient equity holdings to allow them to influence a company's policies or directions. The hedge fund managers thus tries to create his or her own catalyst, influencing the investment's ultimate destiny by creating a desired corporate outcome. For example, the activist hedge fund may advocate for divestitures, restructuring, capital distributions to shareholders, or changes in management and company strategy that will affect their equity holdings. Such hedge funds are distinct from private equity because they operate primarily in the public equity market, while private equity companies consider private equity market. These event-driven strategies tend to be long biased, although merger arbitrage is least long biased among them. The strategy still tends to suffer when the market conditions weaken because the risk that merger will fail increases. And what left is the special situations. These strategies focus on opportunities to get involved in the equity of companies that engage in restructuring activities other than mergers, acquisitions, or bankruptcy. And these activities include security issuance or repurchase, special capital distributions, rescue finance, and asset sales or spin-offs. So pretty special cases. Relative value. Relative value funds seeks to profit from a pricing discrepancy. An unusual short-term relationship between related securities. The expectation is that the pricing discrepancy will be resolved over time. Examples of relative value strategies include the following: convertible bond arbitrage or convertible fixed income arbitrage. This conceptually market-neutral investment strategy seeks to avoid a perceived mispricing between the convertible bond and its component parts, namely the underlying bond and the embedded stock option. relative to the pricing of a reference equity into which the bond may someday convert. The strategy typically involves buying convertible debt securities and simultaneously selling a certain amount of the same issuer's common stock. Residual bankruptcy risks can be further hedged using equity put options or credit default swap derivatives hedged on a credit of the issuer. Fixed income. This strategy is focused on general fixed income. This strategy is focused on the relative value within the fixed income markets, with an emphasis on sovereign debt, at times the relative pricing of investment-grade corporate debt. Strategies may incorporate long-short trades between two different issuers, between corporate and government issuers, between different parts of the same issuer capital structure, or between different parts of the issuer yield curve. Currency dynamics and government yield curve consideration may also come into play. Fixed income, that is asset-based, mortgage-based, and high yield. These strategies focus on the relative value of a variety of high-yielding securities, including asset-backed securities, ABS, or mortgage-backed securities, MBS, and high-yield loans and bonds. The hedge fund seeks both to earn an attractive, highly secured coupon and to take advantage of relative security mispricing. At times, some of these securities may be further parsed into structured note products with unique return attributes relative to interest rate movements and general credit spread changes. Opaque mark-to-market pricing and illiquidity issues are significant considerations. Mark-to-market refers to the current expected fair market value for which a given security would likely be available for purchase or sale if traded in the current market conditions. But in the case of structured products, absent hard broker, dealer quotes is often, and this is often marked to model type of calculation that is less reliable than the actual bid offer spread seen between active market participants. So there's always an issue how you value your investment. Volatility trading. These strategies typically use options to get long or short market volatility, either in a specific asset class or across asset classes. For example, a short volatility strategy involves selling options to earn the premiums and benefit from calm markets, but can experience significant losses during unexpected periods of market stress. A long volatility strategy tends to suffer the cost of small premiums in anticipation of larger market moves, where positions may benefit from both directionally and the ability to rebalance option-based exposure through a variety of methods. And the multi-strategy. These strategies trade relative value within the and across asset classes and instruments. And rather than focusing on one type of trade, for example, convertible charge a single basis for the trade like volatility or particular asset class like fixed income, this strategy instead looks for investment opportunities wherever they may exist, often with different pots of managers executing their own unique market approaches. These in the goal of the multi-strategy manager is to initially deploy and regularly deploy capital efficiently and quickly across a variety of strategies areas as the market conditions change. So the pros for the multi-strategy instead of diversification is also an ability to move your capital across different strategies on a change of the market. And the hedge fund strategies. So macro hedge funds emphasize a top-down approach to identify economic trends evolving across the world. Trades are made based on expected movements in economic variables. Generally, these funds trade opportunistically in a fixed income, equity, currency, and commodity markets. Macro hedge funds use long, short positions and potentially profit from a view on our overall market direction as influenced by major economic trends or events. Global macro managers often have a background in macroeconomics and thus have been trained to analyze how the actions of central banks may affect currency and sovereign debt markets. In many cases, macro managers seek to find trades that may exhibit large potential gains with reduced potential losses. One favorite trade of discretionary macro managers is to short the currencies that the pect means that the conversion rate is set to some global currency, like in this example, Thai baht was set at a fixed exchange rate to US dollar. So they look for the currency and short this currency that is pegged to a rate that the manager believes is too high relative to another currency, and thus the result will be that it will likely be to be devalued. Macro managers earn large profits on the devaluation of the Thai baht, I mentioned, Malaysian and Indian currencies in 1997 and the British pound in 1992. And Warren Buffett was one of its owners and managers of hedge funds that profited well for this move. Risks of the macro hedge funds. Macro hedge funds tend to trade in discretionary way. It can be difficult to predict what the position of fund. Macro managers may have positions that are quite similar to or different from each other. Some macro funds may have concentrated or highly leveraged trades. If an investor is concerned what issues surrounding the currency or sovereign debt markets and sees that they are likely a key risk to their current stock and bond portfolio, macro funds may be a great fit to reduce the total risk of the portfolio to the extent that the fund offers high return in a period of stress. So if your portfolio is exposed to adverse movement in some specific currency or region, then probably addition of macro fund that deals with this currency to your portfolio will reduce the total risk of your portfolio and give the additional return as well. And also we have managed futures funds that are actively managed funds that are actively managed funds making diversified directional investments primarily in the future markets on the basis of a variety of technical and fundamental strategies. Managed futures funds are also known as commodity trading advisors, or CTAs, because they historically focused on the commodity futures. However, CTAs may include investment in a variety of futures, including commodities, equities, fixed income, or foreign exchange. And major futures funds often follow trends, seeking to take long positions when the manager forecasts prices as trending higher and short positions when the lower prices are predicted. The decisions regarding which trades to implement are often based on so-called black box trading system that use proprietary methods of technical analysis to forecast which markets are trending. These trading systems are built using historical data, perhaps to take advantage of the human emotions of fear and greed, which may influence markets, and in unemotional way, the system determines which markets to buy and sell based on how closely the current market price pattern matches the profitable historical pattern. and it's very popular method today. A lot of investment companies employ such technique in their portfolio composition and management, and or at least try to have so. So very popular market and in Russian market too. The greatest risk of managed futures funds is that the markets don't trend or don't behave the way they did in the past. If the computer models are continuously taking positions in the search of trending market that persistently reverses after the position is taken, the fund may be whipsawed and will experience a large number of relatively small losses. Another risk of computer-based funds is that many funds may be using similar systems. Crowded trades can distort market prices. Finally, errors in a computer code may cause the strategy to be implemented in unexpected ways that can generate quick losses. And in a session, I will discuss this effects of tail risk and the risk management. I will give you very sound examples of how these, how great these losses can be, reaching billions of dollars. So that's really the true situation. Let us take a look at the 6 biggest hedge funds. You can see that now they have not followed the right sorting direction. So the second, Renaissance Technologies, has more assets under management, but please excuse me for that. It's effect of adjusting the volumes of assets under management from the previous year. So you can see the top 3 again in the upper part of the screen and others in the lower part. That's for the reason. So Bridgewater Associates. It is an American investment management firm founded by Ray Dalio. Probably some of you already know something about Ray Dalio. The firm serves institutional clients, including pension funds, endowments, foundations, foreign governments, and central banks. It utilizes a global macro investing style based on economic trends such as inflation, currency exchange rate, United States gross domestic product, etc. Bridgewater Associates began as an institutional investment advisory service, graduated to institutional investment, and pioneering the risk parity investment approach in 1996. If we will have enough time, I will also will give a dive in this approach of risk parity investment approach in allocating strategic allocation for your portfolio. But if you only have a time later, in later sessions, of course, not today. In 1981, the company moved its headquarters from New York City to Westport and currently engage over 1,500 employees. And as of March 2021, it has approximately 140 billion in assets under management. Renaissance Technologies, also known as Rentech or Rentech, American hedge fund based in East Connecticut, New York, Long Island, which specialized in systematic trading using quantitative models derived from mathematical and statistical analysis. The firm is regarded as the most successful hedge fund in the world. Their signature medallion fund is famed for the best record in investing history. Renaissance was founded in 1982 by James Simons, an award-winning mathematician and a former Cold War codebreaker. In 1988, the firm established the most profitable portfolio, the Medallion Fund, which used an improved and expanded form of Bernard Baum mathematical models, improved by algebraist James Ax, to explore correlations from which they could profit. Alvin Belkelkamp was instrumental in evolving trading to short-dated, pure system-driven decision-making. The hedge fund was named Medallion in honor of the mathematical awards that Simons and X had won. Renaissance flagship Medallion fund, which is run mostly for fund employees, is named for the best track record on Wall Street, returning more than 66% analyzed before fees and 39% after fees over a 30-year span from 1988 to 2018. Renaissance offers two portfolios to outside investors: Renaissance Institutional Equities Fund, REIF, and Renaissance Institutional Diversified Alpha, RIDA. Because of the success of Renaissance in general and Medallion in particular, Simons have been described as the best money manager on the earth. The fund has around 165 billion in discretionary assets under management, and this accounted to include leverage as figure for 2021. So, and we have the shirt on the top is the AQR Capital Management, that stands for Applied Quantitative Research. It's a global investment management firm based in Greenwich, Connecticut, again, United States. The firm, which was founded in 1998 by Cliff Arsons, David Kaduver, John Liu, and Robert Crail, and offers a variety of quantitatively driven alternative and traditional investment vehicles to both institutional clients and financial advisors. The firm is primarily owned by its founders and principals, and AQR has additional offices all around the world and employs a research-based, systematic, and consistent approach to portfolio construction. This disciplined approach of identifying long-term, repeatable sources of return means having a high conviction in the process, but not a high conviction in any particular stock. So they follow the process patterns, not the stocks. Again, quantitative approach, statistical approach, computer-based intelligence. The firm is a strong proponent of diversification within portfolios, as well as adding strategies with low correlation to traditional asset classes as a complement to existing portfolios. And I should say that for these three top hedge funds, they are also three top gainers for the recent 2 years. So all of them doubled the amount of assets under management for the last 2 years. You can see it compared to other more so-called traditional, but again, the biggest hedge funds that represents the lower part of the screen. The main group, active management business, initially focused on as a Sugar Corporate and the brokerage by James Mann in 1783. So it's a very old, probably the oldest hedge fund or institutional financial institution in the world, and they derived their business naturally from the commodities. They hedged the money that should be given or received by the contractors supplying the sugar and other things to the United States. So they start as a sugar brokerage company. Provides a range of funds for institutional and private investors globally, and is the world's largest publicly traded hedge fund company, reporting that they have 117 billion of funds under management in 2019. Then we have D. Shaw, is a multinational investment management firm founded in 1988 by David Shaw, in New York. Company is known for developing complicated mathematical models and sophisticated computer programs to exploit anomalies in a financial market. D-Show managed 55 billion in asset under management. In 2018, institutional investor reported that among hedge funds, D-Show had delivered the fifth highest return in the world since the inception. And yes, there is some problem, especially with this history of providing additional support for less drops in a net asset value for the funds that want to invest in the meme stocks. So I will not touch in details, but this issues because it's out of the scope of our lectures. But nevertheless, the company survived. Everything is okay. Two Sigma Investments is a New York City-based hedge fund that uses a variety of technological methods, including artificial intelligence, machine learning, and distributed computing for its trading strategies. The firm is run by John Oberdeck and David Siegel, or Siegel, correctly. Two Sigma has been noted for in the business press for its unusually high rate of return, comparable to its older and more mature competitors like D-Show and Renaissance Technologies. So it's very fast-growing company. In October 2013, Two Sigma had raised 3.3 billion for a macro hedge fund in one of the largest new pools of such capital raised in crisis of 2008. At the end of 2016, Two Sigma Investments introduced an artificial intelligence challenge called Halit. Halit is a programming game inviting coding enthusiasts to build smart bots whose goal is to gain control of a virtual grid. It was extremely successful. And due to success of Halit 1, Two Sigma decided to develop a second season of Halit called Halit 2. This ran from October 2017 to January 2018, and in this version, players competed for control of planets using ships. So I think that we will have a Halit 3 soon. Okay, that's enough for I think interesting introduction of the biggest hedge funds. So was it interesting to you, or we shouldn't pay a lot of attention to such points? What do you think? It's okay to have such discussion. Hello? Okay. Good. I'm just worried if you haven't heard anything because no response. Sorry. Okay. Let us have a very brief discussion about the potential benefit and risk of the hedge fund, and then we will have a break and probably will run a small quiz with my pace. So hedge funds were generally a niche business throughout much of the 80s and 90s of the previous century, and supported mostly by hard net worth investors. Traditional long-short equity managers shared the spotlight with successful macro-oriented managers, bringing to mind George Soros' Quantum Fund and Julian Robertson Tiger Management, which took advantage of global currency, equity, and interest rate imbalances between countries. But while hedge funds generally performed well during the dot-com bubble unwinding of 2000-2002, particularly compared with traditional long-only investment products, endowments, foundations, and pensions started to allocate more money to them. Initially investing in a funds after the 2008 period of market stress, they increasingly made direct allocations. So they shifted from investment via fund to direct investment to the hedge fund. They did so in spite of the high fees charged by the hedge funds, and this trend stemmed from an overall effort to achieve better diversification and risk mitigation. This latter area of hedge funds can be characterized by a search for absolute and uncorrelated risk-adjusted returns rather than for outsized upside performance. The institutionalization of the hedge fund industry changed its very nature. Most hedge funds failed to keep pace with the positive equity and bond market advances in the period of 2009-2019, but they maintained place in institutional asset allocation because of their risk diversification properties. And I should agree with this. The role and the portion of the investment to hedge funds gradually diminishes, but still they're a very good instrument in lowering your total risk profile for portfolio. Let's stop by now. Then we have a discussion and calculation about fees, valuation, etc. Let us have a break for 10 minutes. So let's meet at 8 and we will have a short quiz regarding the material I gave to you that will be faced with me. So no problem. Okay. That's the quiz. We'll start it in 10 minutes. Okay. 10 minutes first. Okay, let's start. Please access using the same links that I sent you in the previous charts and in the email. Okay. So sorry, I will stop it right now. Now share the link. Okay. And launch it again. So please start with this free answer question. You can give very short and simple answers. Okay, let us have at least 25 persons answered to move forward. So please give your answers. Okay. Yeah, you're good. So the redemption restriction helps to increase the manager flexibility, to give more time to win the position, etc., etc. Go on. Just put any idea here, so no problem. If you are mistaken in something, just please express your view on it. It helps you to structure your understanding of their subject. Let's put a bit more time for this task, but it will definitely help us. So what is the fund of funds and their primary purpose? Briefly, shortly, etc. Okay, let's move on. I will show you the answer and probably they will give you what it was about. So here are your answers. It's okay, found the fund, yeah, yes, and investing in hedge funds, diversify, also provide access, pooled investment vehicles. Yeah. So you're absolutely correct. That is a fund that hold a portfolio of hedge funds and invest in it. And primary purpose, due diligence, diversified portfolio, and access to smaller investors. And yes, in exam, we'll have a set about from 50 to 60 questions, very similar to that we have on our quizzes during the sessions. Maybe some questions from the quizzes will be included in the final test. So participating in the sessions quizzes help you to prepare for the final exam. That's the idea. Okay, move on. Okay. Yeah, let me see again. Equity hedge fund. Let's distinguish between top-down and bottom-up strategy. You had to understand that the bottom-up means we start with some specific company or asset, then move again up to the sector or industry level, then maybe to some geographical area, and then only to the global. While the top-down approach uses the approach when you analyze something, some trends, some expected anticipated changes on a micro global level, then try to understand what the implication will be on the country level or any other geographical area. Then you can move down to the sector specific features about these changes, and then to the very specific stock you're analyzing. Okay, move on. Okay, yeah, nearly perfect. Yeah, C is correct. The hedge fund have a less complex fee structure than the founder funds. But redemption terms will be better for founder funds, and the diligence of founder funds managers probably will be better than for the single hedge funds, because the single hedge funds has less expertise in a wide variety of investment assets and vehicles. Oops, I put it here. So unfortunately, or luckily, you have this correct answer here. So we just should say that the hedge fund similar to the private equity because they typically structured as partnerships, but others are different. Okay, sorry, well, omit this question. Okay. So again, about the approach employed by event-driven macro hedge fund strategies. They have long short positions. but the approach is different, and the long-term market cycles is not applicable for both of them, because event-driven is primarily focused on some specific event, not the long-term market cycles, while the hedge funds, macro hedge funds, are focused on the long-term market cycles. And again, top-down approach is also not applicable to event-driven strategies, because they are purely focused on some specific issues of specific companies. It's more from bottom-up approach, but maybe even not bottom-up, but very specific approach to very specific event. If you don't know some definitions here, please let me know. I will explain, but I think you can give the right answer even if you are not aware about some specific terms in a trading industry, investing industry. So we will consider. Okay, yeah, the margin call. Margin calls magnify losses. Most of the traders, the hedge funds, uses trading on margin, meaning that they just putting a small deposit as the assurance of their intention at the broker account, and when the position is moving below some acceptable level of acceptable volume, then established by the broker, then the broker give a margin call, meaning that the trader must somehow unwind its position, meaning that you should realize your losses, and it potentially leads to the need to close other positions, and then again this chain of closing position from one investment to another, from one hedge fund to another, can magnify losses for the whole market. Okay. Yeah, let's check what is yeah, fundamental growth takes long position that in a company that will experience a high growth and a capital appreciation. It not undeveloped in a very single moment, that a process of identifying opportunities for growth and for appreciation of capital, rather than just looking for the companies that is undervalued for that or another reason. Because the reason for company being undervalued is not only because it cannot experience a high growth, a capital appreciation. It can be a problem with the debt service, problem with the management. While the strategy that is focused only on the companies with high growth potential should identify the company that experience the growth because of their business, because of raise, for example, of their sales, because of their expansion, etc., etc. Not only because, but not only because of the changes in the management structure, with debt restructuring, etc. So you should focus on the high growth potentials and the capital appreciation potentials. That's all for this test. We have all this knowledge checks only as a sign of your participation. So I will just check everyone who has participated with some tick box, and then it will be counted for the final score that you have participated in the sessions. So you're good. Whenever we will have result of the quizzes to be counted as a part of your homework, I will notice your prior. So don't worry if you're mistaken in some answers. Okay, let's come back to the lecture, and we will discuss management and incentive fees and net of fees returns to the hedge funds. So, although 2 and 20 and 1 and 10 commonly quoted the fee structures for hedge funds and fund of funds, many variations exist, and these variations are the fees based on liquidity terms and asset size. Hedge funds may charge different rates depending on the liquidity terms that an investor is willing to accept. Longer lockups are generally associated with lower fees, and hedge fund managers may discount their fees for larger investors or for placement agents who introduced these investors. Different investors in the same fund may well face different fee structures. Hedge fund managers negotiate terms, including fees and notice and lockup periods, with individual investors via side letters, which are special amendments to a standard offering memorandum's terms and conditions. For perspective, management fees for large limited partners could range from 0.5% to 1.5%, with incentive fee reduced to 10 to 15%, depending on the mandate. Such reductions can be meaningful in terms of net realized returns. However, some smaller hedge funds with strong performance and capacity constraints are able to maintain high fees and may even turn down businesses from a larger investors rather than to agree to a lower fee. So it's always again the question of your quality, your track record, and your performance. Founders shares as a way to incite early participants in startup and emerging hedge funds, managers have increasingly offered incentives known as founders class shares. Founders shares entitle investors to lower fee structures such as 1.5% and 10 rather than 2 and 20, and are typically available to be applied only to a first 100 million in assets, although cutoff thresholds may vary. Another option is to reduce the fees for early founders share investors once the fund achieve a critical mass of assets or performance targets. Both paths act as an incentive to spur investors to make faster investment commitments, rather might to be more passive. And either or fees, the pushback against high hedge fund fees, institutional investors such as the teachers' retirement system of Texas, for example, have recently requested a new fee model that some hedge fund managers have started to accept in return for substantive allocations. Managers agree either to charge 1% management fee or to receive 30% incentive fee above a mutually agreed annual hurdle, whichever is greater. If a manager were to go without profits for a year or two, the 1% management fee becomes effectively an advance against an eventual 30% incentive fee year. So it's mean that the margins are shrinking in this business, and the managers of hedge funds trying to employ new models that allow to bring more investment in a return for a lower overall fees enjoyed by the fund managers. And also a far cry from the traditional 2 and 20, such novel fee structures which are designed to reward performance and the delivery of true alpha about the benchmark are likely to become even more in demand in the institutional hedge fund industry. Hedge funds will likely also endeavor to change high net worth investors with more traditional fees. And we will discuss the in the following examples the fee structure and the effect on the resulting returns to investors. So there will be some calculations, but you have not to do it. It's all already calculated. We're just discussing. So just let us see how the hard hurdle rate work and the soft hurdle rate work. Just imagine you have a hedge fund with 2 and 20 fee structure. You have opening value of 100 and closing value 140. And the hurdle rate is set to 20%, incentive fee to 2%, and incentive fee to 20%. So the profit is 40. Then the value for the hurdle rate is 20. That is 20% or 12% above initial 100 in investment. Then the return above hard hurdle rate is 28. That means that incentive fee, that is 20% of this 28, equals 5.6. While if we have a soft hurdle rate, you have soft hurdle not set, you have your so you have your turning point of either you will receive the incentive fee or not achieved. So you meet the need to have at least 12% of profit. Then the amount of your incentive fee, if you have a soft hurdle rate, will be calculated on the basis of the whole profit. So it's 20 of 40, 20% of 40 equals 8 million incentive fee. Another example, we have a hedge fund opening value 150 million, again fee structure 2 to 20, hard hurdle rate 5%, ending value for the first year 175, for the second year 180, and incentive fees are calculated net of management fees. Let us calculate total fees and investors' net return. So for the first year, we have a management fee that equals the asset under management 150 at 2% equals 3 million, and incentive fee, that is profit, the ending value minus opening value minus management fee at 5%, it equals, this is a hurdle rate at 5%, it equals, let's calculate 25, 22, minus 5% of 6 and 7.5. Then at 20%, it equals 2.9 million. Then it will lead to the total fees of this management fee portion, the incentive fee portion, 5.9 million in fees. And ending value for this fund will be 169.1 because this 5.9 million fees goes out for the manager. And investors' return, you can see the calculations here, equals 12.73%. In next year, we are starting, you should mention it, not from 175, but again, from the result after reducing the management and incentive fee. So we start from 169.1, we have management fee of 3.38 at 2%. Then what are the incentive fees? We have 180 at the end of year 2. We start from 169. We deduct management fee. We deduct the set hard hurdle rate, and we receive a negative result. In a case of hard hurdle rate, in a case of any hurdle rate, that means that we shouldn't receive any incentive fee because our result before applying incentive fee is negative. So 0 incentive fees for the year 2. That lead us to the total fee earned by the management fee company of the hedge fund, 3.382 million, an ending value of the fund 176.6, and it leads to the investor's net return of 4.44. That's how it works. Other example about the high water mark that reflects the highest cumulative return used to calculate incentive fees. Suppose we start in a time period 0 with a cumulative return of 100, then in year 4 achieve a cumulative return of 150, and then we decrease the value of the fund. We definitely do not receive any incentive fee here, but what fee we will receive here, going from cumulative return of 70 to 180? We receive only incentive fee on this portion of our increase in value of cumulative return, because we shouldn't receive the second time incentive fee for this portion. It is only a recovery from previous losses. So we'll receive an incentive fee only for the 180 minus 150 at 20%, $6 million. Let us consider very long example, and should be a basis for your calculation, and possibly the same very same questions will be in the final exam, where I should explain the various aspects of the problem given and answers on the various topics, probably even from various parts of our course. So probably you will be asked not only to calculate, but to explain something, to consider risk return characteristic, etc. Just for you to be used for this kind of things. So we have a WJ Capital, a hedge fund with 100 million in initial investment capital, to charge 2 management fee based on year end. Now please notice these common words here: year end asset under management, and the 20% incentive fee. In the first year, the AWJ capital has a 30% return. Assume management fees are calculated using end of period valuation. So you see that we calculate our management fee not on initial 100, but on the end of the period value of the hedge fund. So what are the fees earned by AWJ if the incentive fee and management fees are calculated independently? What is the investor's effective return? What are the fees earned by AWJ, assuming that the incentive fees calculated based on the return net of management fee, and respectively what an investor's net return? And if the fee structure specify a hurdle rate of 5% and incentive fees based on returns in excess of this hurdle rate, what are the fees earned again by AWJ? Assuming that performance fees calculated net of management fees. So I emphasize these common words you should put emphasis to when you're considering such problems. So what is the investor's net return given this fee structure? Well, let's start with the first three problems. Go on to the page, next page. So the fees are, you see, the value of the fund at the end of the period, and the end of the year one, it's 130 because it's a 30% profit, and equals 2.6 million at 2% management fee. Then incentive fee applies to the whole profit and it goes to the 6 million. The total fees to AWJ capital is 8.6, and the investor's return, the end of period valuation minus beginning of period valuation minus total fees to AWJ, and it leads to 21.4% return. Then we have solution to the problem two. The same calculation for the management fee, but incentive fee calculated on the basis of the profit net of management fee, and it leads to a lower figure for the incentive fee and the lower figure for the total fees of AWJ, and respectively it will lead to the higher return for the investor. So the lower the fee for the manager, the higher the return to the investor. And this solution for the third problem, again the same calculation for the management fee, but for incentive fee we have to deduct this hurdle rate, and we have a lower base for calculating incentive fee, lower total fees, and higher effective return to investor. Come back to the problem. We have additional information that in the second year the fund value declines to 110 million. So if we have the fee structure that is specified in the question 1, and we also include the provision of high water mark, what is the fees earned by AWJ capital in the second year, and what is investor, again, net return in the second year. One, management fee valuation at the end of the period, so 110 million at 2%, 2.2 million. No incentive fee because the fund has declined in value. You see, we decline. So the total fees for AWJ capital is 2.2 million. Then we have to calculate the investor return. We have end period valuation 110 minus management fee minus the valuation at the beginning of the period, and it leads us to the negative return of minus 11.2%. You see here in the footnotes how we calculate the valuation for the fund in the beginning of year 2. Then we have 2 more problems. In the third year, we have a fund value increased to 128. So if we have the fee structure specified in the questions 1 and 4, what is the fees earned by AWJ? What is the investor return? And The sixth question, what is the arithmetic and geometric mean annual returns for this 3-year period? And what is the capital gain to investor over the 3-year period? And what are the total fees paid to AWJ for the 3-year period? Let us consider. We have 128 of value for the fund for the end of year 3. It leads to the management fee 2.56. Then you see the incentive fee is ending valuation minus opening valuation and leads 1.32 million. So the total fees to AWJ is 3.88, and investor return is 50%, around 50%. The solution to the problem 6, we have just a mean annual return plus 21 in the first, minus 11 in the second, and plus 15 in the third. That's 8.4 roughly. Geometric mean return, it is the cube root, so because we have 3 periods and we have ending value of 124 and starting 100, so it's been lead us to the 7.5 roughly. But also give us understanding that the geometric mean annual return, also called like CAGR, cumulative annual growth rate, is more correct, the more efficient measure for the investor to understand what are the actual returns on a long time perspective. So what is the average increase, compounded increase in his or her investments made from the first year? Then the capital gain for investor is 24 million, and the total fees paid to the manager is 14 million. So you see that we earn only 24 on this investment, while our manager earns 14. So like 60% of our return. So we shared nearly 3 to 2 our total return on this investment. That's why the pressure on the fund managers to decrease their margins, decrease their management fees is so high, because you can see the investors are paying a lot of his or her return as a management and incentive fee to the manager of the fund. And very simple calculation, but I should mention it here. We should compare the returns of investing directly into a hedge fund or through a fund of funds. So let us consider the investor who is contemplating investing 100 euros in either ABC hedge fund or XYZ fund of funds with this fee and incentive and management fee structure 1 and 10, 2 and 20. The management fee are calculated on an annual basis on assets under management in the beginning of the year, and management fees and incentive fees are calculated independently, and the ABC hedge fund has a 20% return for the year. Let us calculate the return for ABC, the return for XYZ, and compare. Very straightforward calculation, but it gives us understanding what is happening. Profit before fees for the just a very simple fund ABC, it's 20 million, management fee 2 million, incentive fee 20%, 24 million. That leads us to the return for investor 13%. Then we have a fund of funds. The fund of funds earn the same 13% on his investment into ABC hedge fund. So the XYZ fund of fund charges the investor management fee of 1 million, that 1% of 100 million under management, and incentive fee, the 10% of this already earned by ABC investment in ABC hedge fund, 30%. That led us to the 10% of from 14 million, 1.4. And finally, it leads to 11.6. You see that the investment in a fund directly led us to the return of 13%. Investment via fund of funds lead to a lower margin of 11.6. Why investor should consider investing in fund of funds but not in ABC? Yes, you already answered in a quiz, because it provides more due diligence, more expertise, and provides a greater diversification and access. Okay, let us have a brief discussion about some specific issues in calculated returns and valuation of the hedge funds. The hedge funds have the several specific characteristics like leverage, liquidity, and redemption terms. And these features provide and affect the calculation and valuation of the hedge funds greatly. Hedge funds may use leverage to obtain higher returns on their investments, and leverage has the effect of magnifying gains and losses because it's allow for taking a larger position relative to the capital committed. Hedge funds leverage their portfolios by using derivatives or borrowing capital from prime brokers, negotiating with them to establish margin requirements, interests, and fees in advance of trading. The hedge fund deposits cash or other collateral into a margin account with the prime broker, and the prime broker essentially lends the hedge funds the shares, bonds, or derivatives to make additional investments. The margin account represents the hedge fund's net equity in its positions. The minimum margin required dependent on the riskiness of the investment portfolio and the creditworthiness of the hedge fund. The very same apply to individual investors. So if some of you is already participated in as a trader, you're probably already aware of such things. Leverage is a large part of the reason that some hedge funds either earn larger than normal returns or suffer significant losses. If the margin account or the hedge fund's equity in a position declines below a certain level, the lender initiates a margin call and requests that the hedge fund put up more collateral. An inability to meet margin calls can have the effect, as we already mentioned, of magnifying or locking in losses, because hedge fund may have to liquidate, that means close the losing position. This liquidation can lead to further losses in the order size is sufficiently large to move the securities market price before the fund can sufficiently eliminate the position. Under normal conditions, the application of leverage may be necessary for yielding meaningful returns for given quantitative arbitrage or relative value strategies. But with added leverage comes increased risks. For example, in August 2007, a sudden cascade of problems arose from the application of leverage. So-called unattractive stocks rallied sharply over a 10-day period of short covering, while stocks deemed fundamentally attractive declined as quantitative managers were forced to sell them. Many managers positioning themselves as market neutral and safe quickly lost 20 to 25 of their profit portfolio value. So even if markets think that these stocks are fundamentally attractive and these are not attractive, sudden sharp changes in the market positions can, in leverage market positions, can lead to the margin calls, then to subsequent liquidation of position. And that was the case if someone follows the stock market in the United States, you can recall these AMC and GameStop companies that was rallied so high, of course, using some new methods of pulling the individual investors that leads the institutional investors to liquidate their position. I will not name any companies, but probably if you follow the market, you know what I'm talking about. And the tail risk aspect of such strategies was revealed to be the leverage and the crowding phenomenon of so many market participants holding similar positions that needed to be downsized when the market moved. Leverage can cause left-tailed events when mechanical downsizing and crowd psychology impacts come into play. Market watchers say that the source of the 2007 upheaval was no more than the butterfly effect of one levered quantitative manager after another deciding to delever at the same time. And we can see that this not the one problem. It will repeat constantly. So the history is repeating. The applications of leverage to a strategy may not be revealed by studying the Sharpe ratio, the Sartini ratio, or another financial performance metric. Instead, it may underpin the strategy undetected. Understanding the impact of leverage on a portfolio is less about what the track record has been and more about how that track record was created. Analysts evaluating the alternative asset space should therefore scrutinize the returns of any alternative asset that relies on high leverage. So please be aware in your professional or personal investment about the issue of the high leverage. You should carefully consider the implication of this leverage. Illiquidity and potential redemption pressures. A second qualitative issue for many hedge funds is the matter in which portfolios are marked to market. This issue is less important for traditional long-short managers trading only publicly traded equities, but it still can cause problems. Consider a long-short equity manager involved in a thinly traded small capitalization stock that see only a few thousand shares traded daily, and perhaps the manager was able at one point to source a block of stock from a retiring firm founder in order to establish the long exposure. An outside fund administrator uses a daily quoted price to value these shares, but the manager knows there is a little chance of actually liquidating all the shares at that price. This problem will be worse for a convertible bond manager, a credit-oriented manager, or a structured product manager who faced quite a bit of spreads and deals in some securities that are particularly illiquid or that trade maybe only by appointment. That, in other words, securities that trade so infrequently, then an appointment to trade this security is almost necessary. Proper valuations are important for calculating performance and meeting potential redemptions without incurring undue transaction costs for liquidating exposures. The frequency with which alternative assets are valued and how they are valued vary amongst funds. Hedge funds are generally valued by manager internally, and these valuations are confirmed by an outside administrator on a daily or perhaps weekly basis. Performance is reported to investors by the administrator on a monthly or quarterly basis. The valuation may use market values or estimated values of the underlying positions. When market price or quotes are used for valuation, funds may differ in which price or quote they use. bid price, ask price, average quote, or median quote. So the common practice is to use an average of the bid and ask price. A more conservative and theoretically more accurate approach is to use bid prices for long positions and ask prices for short positions, because these are more realistic prices at which the positions could be closed. In some instances, the underlying positions may be highly liquid or even non-traded investments. And since such securities may have no reliable market values, it becomes necessary to estimate values. And starting from year 2006, with later amendments and modifications, GAAP accounting rules in the United States create a methodology that involves the categorization of investments into 3 buckets: level 1, 2, and 3 pricing. Level 1 asset involves situations where an exchange traded, publicly traded prices is available and is mandated to be used for valuation purposes. When such pricing is not available, outside broker quotes or level 2 values may be relied on. As the final recurs, when such broker quotes are deemed either unavailable or unreliable, assets may be computed using only internal models, a process referred to as level 3 asset pricing. No matter the model used by a manager in such circumstances, it should be independently tested, benchmarked, and calibrated to industry accepted standards to ensure a consistency of approach. Because of the potential for conflict of interest when applying estimates of value, hedge funds must develop procedures for in-house valuation, communicate these procedures to clients, and adhere to them. Best practice, the very nature of assets that can be valued only on mark-to-model basis can and should be a concern for the alternative asset investor. The model may reflect an imperfect theoretical valuation and not a true liquidation value. The illiquid nature of these assets means that estimates rather than observable transaction prices may well have factored in any valuation. As a result, returns may be smoothed or overstated, and the volatility of returns understated. And that is the case for nearly all classes of alternative assets. It's really hard to find reliable quotes for them. In some classes of alternative assets like real estate, only model valuation or appraisal can be applied, and we will dive in details in the sessions devoted to real estate and alternative investment type. So another issue, you have to understand and evaluate detailed events, that is low probability, high severity instances of stress, is an important yet extraordinarily difficult aspect of the risk management process, particularly when dealing with illiquid securities. Stress testing and scenario analysis are often used as a complement to other risk measures to develop a better understanding of a portfolio's potential loss under both normal and stressed market conditions. Stress testing involves estimating losses under extremely unfavorable circumstances. Another factor that can lock in or magnify losses for hedge funds is investors' redemptions. Redemptions frequently occur when a hedge fund is performing poorly. Redemptions may require a hedge fund manager to liquidate some positions and potentially receive particular disadvantages prices when forcing to do so by redemption procedure pressures, while also incurring transaction costs. So you not only close your position with loss, but you have to pay transaction costs. And funds sometimes charge redemption fees to discourage redemption and to offset the transaction cost for remaining investors. Notice periods provide an opportunity for the hedge fund manager to liquidate a position in an orderly fashion without magnifying the losses. Lockup periods, it is time when investors cannot withdraw their capital. These lockup periods provide the hedge fund manager the required time to implement and potentially realize the strategy's expected returns. If the hedge fund receives a drawdown request shortly after a new investment, the lockup period forces the investors who made the request to stay in the fund for a period of time rather to be allowed to immediately withdraw. A hedge fund's ability to demand a lockup period while raising a significant amount of investment capital depends on a great deal on the reputation of either the firm or the hedge fund manager. The fund of hedge funds may often offer more redemption flexibility that is afforded to direct investors in hedge funds because of special redemptions arrangements with the underlying hedge fund managers. So they know each other better, they have other connections, other special favorable terms, and the maintenance of added cash reserve, access to temporary bridge loan financing, or the simple avoidance of less liquid hedge fund strategies helps to have a better terms for the funds of funds. And ideally, redemption terms should be designed to match the expected liquidity of the asset being invested in. But even with careful planning, the initial drawdown can turn into something far more serious when it involves illiquid and obscure asset. So please be aware of these characteristics of the alternative investment, that is illiquidity. It's a very simple question that we can leave behind. That what are the best choice to evaluate the hedge funds? I will ask you to answer it at home, just to test yourself. While we will move to the final discussion about the due diligence process. It's a very interesting and important topic. Investment strategy and process are challenging to fully access because hedge funds may limit disclosure in order to maintain their competitive advantage and to not give away information that is considered proprietary. It should be possible, however, to identify in which markets the hedge fund invests, the general investment strategy, for example, either it's long, short, relative arbitrage, and so on and so on, and the basic process to implement the strategy, and the benchmark against which the fund gauges its performance. Track record is a commonly viewed consideration because it should be readily available and is often assumed to be an indicator of future performance and risks. I think it's perhaps incorrectly, because it's based on the studies of performance persistence. And the investors should determine how the returns are calculated and reported. For example, either they calculated based on the estimates of value or market prices, quotes, or they reported before or after fears, and how the returns and risks compare with some benchmark. The investor should inquire about the fee structure because this information will affect the return of the investor. Size and longevity are also common items for review.
The older a fund, the more likely it has not caused significant losses to the investors. As a result, older funds are likely to have experiencing growth in the assets under management through both capital appreciation and additional investments. Many investors require hedge funds to have a minimum track record of 2 years before they will invest. This requirement makes it particularly difficult for startup funds to raise money because the managers need capital to invest before they can build a track record. In many cases, startup funds receive money from seed investors who want a share of the business, and we already discussed these clauses. A thorough due diligence process will also include a review of management procedures, including leverage, brokerage, and diversification policies. The use of leverage and counterparty risk can significantly affect a fund's risk and performance. In addition to gathering information about the fund's prime broker and custody arrangements for securities, the investor should identify the auditor of the hedge fund and ensure that the auditor is independent and known for conducting competent audits. So we will again return to the issues of risk management, due diligence for all classes of alternative investment in a sessions that will be solely devoted to the process of risk management and due diligence. For now, we finished with hedge funds introduction. We dive in some details. What I want to ask from you is to pass the next quiz. It contains only, it contains only 4 questions. Yes, navigation. Okay, only 4 questions, but it needs calculations, so I kindly ask you to answer this quiz. Please use your credentials that meets the list of your group participants, because I will consider the results of this knowledge check as a part of final score, but with very small weight, so no problem with that. But please be careful. No problem if you answered incorrectly. We can discuss it. So it's the first attempt to pass the test that will be counted in a final score, not only as a token of participation, but also with respect of results you achieved passing this test. So it will be open until next Wednesday. Please try to have only one account associated with you in this test. Like here we have already 2 Philips. Please do not follow this practice. Try to do your best. Any questions regarding the hedge funds or any other issues, please let me know. You need the link? Okay, I will send the link again. Please have the link. So I'm ready to answer you and help. If you have any questions, please raise a hand or type in the chat. If it is no, I would like to thank you for your time. Wish you luck with this short quiz. Be careful.
make correct calculations, and see you in a week. And most of you will also participate in the next session on investment project management. So probably see you until Saturday. Bye-bye.